Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, March 17th, 2022. What I'll do in this video is a brief update on the equity markets and crude oil, and we'll just keep this one relatively brief. It's 3:01 right now, so we've got about an hour to go in the trading day. This is NQ. As I mentioned recently, have sort of pivoted at least near term to even intermediate term right now on the the outlook for more downside in the market. It very well may come, but we've had nothing but bullish developments. You can chalk it up to the Fed day, but we've had follow through today. So yesterday, just to recap, I told you that we had just taken out by a relatively small margin this downtrend line. I've been really harping on this downtrend line for a while. It forms a bullish falling wedge pattern on the 60-minute charts. You also have it on the daily charts. And as I said, we had the Fed day, a lot of noise, but we took it out, closed above it. We had a beautiful pullback trade in the Fed yesterday, after the announcement, and able to game that, or at least, if you're an active trader, you would. And we had an uptrend line here that was taken out, but here's the most important thing. This line is everything. And I mentioned yesterday that if you got a back test of the trend line, that would be an objective a long entry, and that's exactly what we had. So this is textbook. Now, I have some concerns. So really what I'm doing right now, I'm keeping it light. I've had a good run recently, and as far as the indexes go, I'm going to let the dust settle. This is only day one after the FOMC meeting, so we've only really one full trading session if you count, it was at 2 p.m. the announcement. And again, it's nothing but bullish. So there's no reason, in my opinion, right now to add any shorts. If anything, you should be subtracting shorts after the breakout and successful back test. It could fail, and my confidence isn't so high. There's a few things I'm seeing that give me pause. Now, one of them is you have remember yesterday in the video I talked to you about the PPO buy signals that you get down here when you hit this red line, this high level on the PPO, and I showed it on QQQ as well recently. I'm sorry, sell signals, and it's that tag of that level. But I said what happens most often is you have a tag of that level, then a lower high in the PPO, aka or i.e. negative divergence. These are your divergent highs, and each one of those, that's 1, 2, 3 right there with the tag to that level. And so far that's what we're setting up for, it looks like here. Now, the tough part is, as far as that's been a great shorting up, and it may prove to be, and I think it can probably be another pullback up. But here's the thing: this supersedes a lot of what's going on down here. In a bear trend, you're going to short these divergent highs, and it's usually the next leg down: divergent high, divergent high, divergent high, divergent high, divergent high. You're probably going to get one here. It's almost certain. Actually, we have one right now. Technically speaking, it's not what I call confirmed divergence, but I'm going to zoom in there a little bit more for you in the video, and you can see that prices are making a higher high from this peak from this one, and the indicators are making lower highs. So there's that. And again, so it leaves me, there's cross currents, bullish breakout, and the fact that we had a successful back test today is another check mark for the near-term bullish case. And this could be, it could be a lot of things, and it could be the rally, a beginning of a rally to go out and maybe test the previous highs, break out the new highs. There's also plenty of resistance overhead, like I said, and so to me, it's just a little, I'm just not feeling it. So you trade as you want, and I can tell you all day long, it is objective to be long here with stops below that level. Maybe we'll back test it again, but you want to stop either below about here, I'd say about 13,800 or the downtrend line. I'll get to QQQ in a second for you, but again, I just wanted to mention at this point in time, there was a breakout and a back test. I ain't buying it. Now, I'm not buying it literally, but I'm also not buying this whole thing just yet because this is still based on the long-term charts. Even though I've pivoted near-term here, based on the long-term charts, there's still a lot of bearish developments and a lot of things in play. And this could be, there were some, we had along the way here, we had bullish falling wedge breakouts. And what happened is they didn't play out for a move to new highs. They just played out for a relatively short rally that then got sold into. And if you strip away all the lines, let's do that. Let's get to QQQ. Here, let's look at that for you. So here's the QQQ, same 60-minute chart I've been posting for a while. No, I might have added a few horizontal levels on the lines, but the downtrend line and the divergence lines remain the same. And there's the breakout right there. But when you turn off all the lines, this is pure price action. This is what we're looking at on QQQ, which peaked back in November, and it is in an unmistakable downtrend for now. So that's one reason that, hey, I'm pointing out these bullish wedges in the daily and the weekly chart. I'm pointing out the fact that the recent lows have been defended on numerous occasions so far. PPO, or the RSI thrust, is higher than the previous thrust down there. That's broken that trend. But again, bigger picture, and that weighs heavy into my analysis, is what's going on the long-term charts. The daily, especially the weekly charts, and in some cases, some things I'm seeing on the monthly charts. So, here's the good thing about it. I'm going to pose a question. If I had to, let's say, I always use this analogy, I'm going to sail around the world for a year, and I can only do one trade, and I can't set stops. I have to leave it alone. I could either be long or short the market. Right now, I'd be short. Maybe not for a year, but let's just say for the next 3 months, 6 months. Let's say 6 months, and that's what I would be. I feel that the risk reward is still skewed to the downside. So if you are short the market and you want to give it room, well, there are no guarantees. We may see more upside on the counter trend rally, but I think we're going to go on and hit my targets that I've given you this year, and we'll get to those right now. But I just want to show you that's what's going on, and I'm going to show you a couple other things on the put to call ratio that certainly comes into play. Let's jump all the way out here. I already talked about the divergences in the daily chart, but you also have the MACD on the daily chart clearly in bearish territory. When it's below these lines I have right here, and I'm referring to the signal line on the MACD, that's the 9 EMA. It's the white line. It's the last of the two to cross. As you can see, when it's below those levels, which I have just a little below the zero line, which is the dashed line up there, you're in a bear trend. You're in a bear trend now. Clearly, by that one indicator, you were in a bear trend all along here. And if you look at that level, that was the Q4 2018 drop. You can see you crossed below it right here, and you had some big counter trend rallies. I mean, these had a lot of meat to them. That one was about 10.5% right there. But guess what? You were in a bearish trend by this indicator, and back test to that level again. White line is the last of the two to cross, so that's why you give it the benefit of the doubt. Rejected right here. The PPO from below rejected again. That was after the bearish cross, and boom, what happened on those rejections? You had another leg down till you finally took it back out. So again, it does a pretty darn good job. And if you roll back, which this daily chart won't do it, you go back to last bear market and you're going to see you were above there, below that level for quite a bit. And I also mentioned that if it is a early stage bear market, what's going to happen? It's going to look. This is bull candy right here. Like I said, I'm acknowledging it's a very bullish looking setup. But if it fails to play out, then that is a signature trait of a bear market. When you have these textbook looking bullish setups and they just fail to materialize for anything more than a bear market rally. And so, again, those are my thoughts. And I gave you where I think if I think this is most likely not going to take us to new highs, and most likely not going to play out for a move up above even back test of those recent lows. At most right now, I'd even say the 200 days. If we get rejected sooner, which I would put decent odds on, this thing could just crap out. And then I can always start adding back shorts when I see that happen. And you know me, I'm flexible. A couple week to ago, I said, stay away from crude. It's so headline driven. And lately I've been trading crude, with some pretty accurate trades on that. That's put a lot of money in my pocket too. So, and I'll get to that one in a second. But and so hey, I could be short QQQ by 3:59 p.m. today if I see something different that I didn't cover in the video, something convinces me. And today I've just been day trading. I had like 3 in and out trades, went 3 for 3 on the NQs, just small moves, and then sit back, and then I'll just wait for the next active trading op, and then I'll also let you know about swing trades. But I do want to say that I'm just going to end this here and we get to the weekly chart, that if you are a long-term trend trader, I didn't do a 180 pivot. I've just reduced short exposure, as I said the other day, and I still have some long-term short positions, not what I had recently, But and I may add back now. If you shorted up here, we had sell signals here. We've had sell signals. We've had sell signals all along the way here. We've had buy and sell signals. I've mentioned objective long and short entries. But if you have a decent average cost somewhere up here around the 200 days, you can let that go. If you are a longer term swing or trend trader, I didn't mean to do that. Here's a weekly chart. This is the big picture. I still believe, and I think it'll happen this year, we're going to visit the long-term bull market uptrend line, go on to hit my deeper targets. T2 is down there around 299 to 300, T3, T4, and right now all we're doing at this point in time this week, and it was a Fed week, so remember what I said earlier, you're going to get volatility. That's a guarantee. I guaranteed that this week. I give few guarantees, but that one was a guarantee. You're going to have volatility because the VIX was already elevated. Volatility was already here. You throw in one of the biggest FOMC meetings in the past decade or more, yeah, you're going to get volatility. And volatility cuts both ways. It means up or down. And that's what we had. Now, if you take everything away that's happened, take away that 60-minute wedge breakout, here's what happened. This was to me, a very big level. It was a previous all-time high, and QQQ, the Qs broke out above that all-time high there, successfully back-tested it here, but it failed it right here, and we're below it, and now we're back-testing. So from a very simple point of view, you do have a downtrend line, which as of now is being taken out, but hey, there's 1 hour and 1 day left to go in the trading week. We've got another hour today and all day tomorrow. This candle could easily close back below there, and which would mean two things. It's going to mean, if that happens, a rejection off that 342-ish level, which was my first target, which was hit back here. It would be a rejection from following a back test of that level. And it would also mean that we remain below the primary downtrend line. And yeah, it is the same trend line that comes in on that 60-minute chart. So if we back test it, look, we already back tested it once on the 60-minute time frame. We could back test it again, but usually the second back test, especially in the downtrend, is going to fail. So that's it. Kind of mixed stuff. I'll let you guys decide what to do with your positioning. I just don't think it makes sense to be aggressively long right now or aggressively short. Hopefully that's pretty clear. And then all this stuff, this is the monthly. And the monthly, we say the longer the time frame, the more significance it has on my weighting. The more significant it is that I factor in what's going on in the bigger picture. And here, I've covered this many times. Down here on the very bottom of the chart, this is the PPO histogram. Green when the PPO is in bullish mode. Once you get a crossover, meaning the PPO line is above your signal line, which I'll make that white so you can see it a little bit better in the video. There it is. And when the PPO line crosses down below, the histogram goes red. And I've talked about this. I try to rank indicators, and there's a factor. Number one, obviously, how reliable is an indicator? How reliable has it been in the past? Higher the reliability, the higher the ranking, right? And the other factor is simplicity, because there's all kinds of complex things that you can do, but for something so simple as watching the color change from red to green, and it has coincided with every single one of these drops, zero exceptions, zero whipsaws. We're going back here decades. We're going into the 90s. And so 84% drop, 18, 55, 16, 13, 26, 24, 31, and I put 22 in a question mark because it's not over yet. And we haven't crossed. It could be, the correction could be over, but it may be early stage bear market action like it was back here. All I can tell you is all those drops there, each and every one was even at 35%, or I'm sorry, 31 in the Nasdaq, high to low, it was coincided with a crossover on the PPO. Fed came in and saved the day, but you still was associated with that 31% drop. So based on the technical posture of the markets, I believe that this 22% drop is probably not the end. However, there's another indicator here that I've told you for effectiveness. It's right up there with a 10 for, with a combination of effectiveness and simplicity, and that's this 20-month exponential moving average. It does a phenomenal job of defining bull and bear trends, bull and bear markets, And simply you look at, is the Nasdaq 100 or S&P 500 above it, as it was from all its way. That was one of the greatest bull markets, especially in the tech heavy Nasdaq 100, and that was up to the dot-com bust. Bubble busted in early March of 2000, and then you boom crossed over there. So if you took all your 401k money out, all your investments out, or you wanted to profit, not just avert those big losses, and you followed this signal, well, you got out there, you had a solid monthly close, and you stayed out, and you averted that whole bear market. And I'll even say if you waited to the end of the month and that monthly close, which is certainly well off the top, you still averted at that point a 70% drop from that level right there. And so anywho, you can see like any good moving average, when you're above it, it will also act as support on pullbacks. Then once you break it, as you did here, you back tested, boom, another bear market. Successful tests, numerous tests. Again, put this up on your own chart, use an exponential 20-month moving average on a monthly chart. And you can see the stick save right here. See that green candle? We were down there below the month to close back above it. Same thing right here. And boom, we just hit it. So I would be surprised to not see a bounce, but we've been testing it now for almost the last 3 months. We almost hit it that back in January. We went through it, but had a close back above it yet last month in February. And so far, we're just a hair above it. So the million-dollar question, from this long-term perspective, and we won't know the answer for another couple weeks, is it another great buying opportunity on a pullback and test to that level as it's been for quite a while, or is it the start, or are we going to take it out? We haven't taken it out yet, but when you come down and test it, there's always that risk when you fall to support. I talked about that yesterday on a much shorter time frame on that 60-minute chart. We were, after the Fed announcement, after we broke above the bullish falling wedge on the 60-minute chart, we're much higher. We're comfortably above. What was it? I think I said 7 or 8% at least above the recent lows. So there was at that point no risk. The market's not going to drop 7 or 8% in a day. They don't even let it do that anymore. Circuit breakers will kick in. So there was no risk yesterday, nor is there a risk today of us taking out those recent lows. And until we do, we're not going to take out the 20-week or 20-month moving average and a lot of other key things. But again, this indicator also on the monthly PPO clearly bearish, and so that's it. So kind of a mixed bag. Anybody's game here. Bulls need to keep powering on up, get it away from that 20-month moving average, go up on the daily chart, take out the 200-day simple and exponential moving averages, and take out resistance. They can do it. They've got a nice bullish chart pattern, a breakout recently, and they have bullish divergences. So the ball's in their court. And if they fail to do it, if they drop the ball and we move back down and the breakout fails, especially if the recent lows fail, that to me is an all-in short moment. So, all right, we'll leave it there, and I'll just show you the put-to-call ratio real quick. One of many things that I cover, look at for sentiment. This is one of my favorite. Let me move this chart up a little bit, see if I can squeeze it in the video a little better. This is the CPCE, which is the equity put-to-call ratio. So it measures the ratio of put buying versus call buying on individual stocks. And it is one of my favorite indicators. It's a sentiment indicator. And as a sentiment indicator, those are contrary indicators, meaning when everybody's bullish, that's when you want to be bearish. And when everybody's bearish, only at extremes. That's what I've always said. Sentiment indicators, whether they're AAII surveys, where they survey people if they're bullish or bearish, or if it's actual put-to-call ratios, there's various ones. To me, they're absolutely useless anywhere in the middle because it's just noise. What I look for are extremes. So a long time ago I've noticed that I have a level here that I added about 112, which is an extreme bearishness. When the CPCE spikes to that level, that's when you want to be buying. And there's also this extreme bullishness level down here at about 0.38, and that's where you want to get out of your stocks or get ready to short. Not just based on this indicator, because I always say this is not a timing indicator, at least not an exact timing indicator. This shows you conditions, the same conditions that I talked about for the last couple of months, and they're still there. I'm at this point in time, if we want to play the little game, I use the analogy of the National Weather Service. Um, we'll issue a hurricane. We'll put the market back from instead of a crash warning to a crash watch right now. And if we take out or get back close, anywhere close to those recent lows, I'll put it back to a crash warning. And the difference is, watch, hey, heads up, the conditions are there, and we could have one where a warning means the conditions are much more likely that you're going to experience it, so a warning is more severe than a watch. And so right now we're on a watch, but we could flip back to a warning in a day or two. So hope that makes sense. All right, so here's the levels. If you hit it, boom, you had a buy signal there. You had one right actually here too. Boom. I'm sorry, sell signal. We hit the line right there. Boom, big drop. Hit the line there, big drop. Hit it there, big drop, and then we also was followed by, that was early on in a nearly 2-year sideways market that was marked with a lot of big corrections. And then what we had here is what I call a cluster. We had persistently low readings. That means excessive bullishness not ever seen in decades. We hit that extreme and stayed down there. And that's why I still think there's going to be a big day of reckoning for that. It means everybody was loading up on calls and bullish, and very few people thought the market was going down, as evidenced by the extreme low put to call ratio. And so that cluster, what you look for when you start tagging the level, again, that's not a timing indicator. It shows conditions that persisted for quite some time, and we finally started to lift off, and that's usually when the drop comes, after you start to lift off those levels. Likewise, this 1 2 3 1 2 3 4, this is when you want to buy. You wanted to buy here and here at the end of the bear market. You wanted to buy, you got that signal right here at the end of that nearly 2-year bear to deer market. A deer market's neither bear nor bull, it's a sideways market, but there were 2 big corrections in there, close to 20%, and it said buy it right there. Everybody got scared, and that's when you wanted to buy. It happened again in the fourth quarter drop of 2018. You hit it right on the bottom, and that happened to be a perfect timing. And same with COVID. Boom, you hit it to the button. And now where am I going with all this? I know I've covered this a lot. Nowhere close. There's no fear in this market. The Fed put has been removed to a very large, if not complete extent now. But people are just conditioned, like Pavlov's dogs, buy the dip, buy the dip. The Fed's never going to let the market go down. They saved the day back, and they did a pivot back here. They had started getting a hawkish, and they did a 180. And I called it in advance that they would do that 180. This time around, they don't have. I'm not calling that. I made that call there, that the Fed would pivot and go back from being hawkish to dovish, and they certainly did, and they started flooding the money. They took rates back to zero. COVID, they went nuclear. They just don't have that option anymore, not with inflation running the way it's running, not with our deficit ballooning. So for many reasons, I'm not going to say every single arrow in their quiver is gone, but there aren't many left. Especially if inflation continues to surge. Look at crude prices. I'll get to that in just a second here. All right, so that's it, guys. I don't see the evidence of a bottom based on the correction and based on the technicals. And so that's it. So I've moved to a little bit more of a cautious positioning lately, but I'm ready to get back in fully short, and I'm not ready to tuck away and start putting out long trend trades. If you are bullish and you do, there's a lot of beat down stocks. People have been wanting to buy Apple and Amazon forever and a day, and Microsoft. You have your opportunity now, and I know there's going to be dip buyers that already are stepping in. If I thought it was a time to tuck away those stocks right now, I would tell you, and I can tell you, you can do it with stops above, with reasonable stops, not too far below, because we're not too far off those lows. And I may end up doing that or putting out some trade ideas on those with targets. Just not right now. I want to see. Let's finish this week, see how we fall through tomorrow and into early next week, and then I'll decide whether I want to nibble on some longs or start nibbling back on shorts. It's going to take probably a reversal to nibble back into shorts, but you know me. Well, that view can change tomorrow. All right. Last but not least. We have crude oil. And in the trade, I laid this out as a trade idea with an objective entry on Tuesday. Then I followed up again on Wednesday on the back test. It was right here and here. And I even made a point in yesterday's video, although I didn't get to it, it was because that was exclusively on the market, to reiterate that I was still bullish on long crude. There was our first buy was somewhere in here, and then again when we back tested, wherever it was, you can, those charts were posted today. But this was a beautiful setup. I mean, we had a nice long-term trend, or a nice primary uptrend line even goes to the left of the chart. In addition to that, so you know me, I like to buy where I buy long side trades, or where I go long. What's objective are one of two things: either a break, either a pullback to support, which that was, and that was, those are your two objective entries, and or a breakout above resistance. In this case, you had a bullish falling wedge. These are my favorite patterns. When I have a bullish falling wedge, and at the same time, right where the wedge is getting ripe for breaking out, and that's usually about 70+%, maybe 80, to give or take 65% to the apex of the wedge. Apex meaning where if you take those lines, they're going to cross. That point, you know, this is the ripe area for a breakout in a wedge. So when you have it falling to support, and then of course you had horizontal price support, it doesn't get much better than that. And so it was a nice trade, and I laid out initially a target of 105.15 because I was in the April contracts, but those are rolling this week. And you have, here's what I was going to show you. We hit that level, we're a hair above it now, but I'm going to zoom in on this a little tighter. Here's why I closed that trade out early and then rolled into the maze and shorted those. That was original target, but this was a reaction high here. You also had a little reaction there. And then more so about the maze right here. Let's go. That was, again, April contract. It's deceiving because April contract, stops trading at the end of March. May contract here. There's that beautiful bullish falling wedge. The beautiful uptrend line. Perfect tag. I know, I'm sorry, I'm a geek with technical analysis. I speak like a art enthusiast might about a Monet painting. All right, so you have this level right here, 101.90, and for all intents and purposes, we're still at that resistance level. We pretty much stalled out there all day. We're at 102.10, close enough, right? And then just above that, just like you had that level above on the April contracts, you have resistance at 104.10. If it happens to pop this level. I don't think it's going to. PPO is starting to turn down here, RSI's turning down, and then right here you have, sometimes it's hard to see in the videos, I'll tighten up for you. You have a little uptrend line. I'm going to show you this. You have two of them. You have that one right here, which we broke today, and we're back testing right now. Then you have this secondary trend line right here, and that's exactly where my target comes in. So I'm short crude here. My contract's looking for a pullback to 98. I'll cover just a little above that to not try to milk out the last few cents. I'm not concerned. I know the risk rewards it's decent. It's about almost a 3-to-1. I'll let it run up there. I'll only be concerned if we can power on through 104. So I'm going to give it a fairly wide stop for now, and I'll show you why. I also have the let's see. I'll drag this one down from up here. There it is. This is the 5-minute chart. I told you I trade off the 5-minute quite a bit. NQs, anything. A lot of things trade well off the 5-minute, 15-minute. You can go to various time frames, but here's what you have. So on the 5-minute chart, I have the line, instead of at 101.90, I have it at 102. That says 102.1 right there. We're right at that now, and there's that shorter term uptrend line I just drew for you on the 60-minute chart, and there's the breakdown and back test right now. So it's a hair above resistance, a little bit of a momentum fueled overshoot, but it's pretty decent resistance. Look at all these reactions right there and there and there. So this is where I think this one's going down to. Oops, that should have been an arrow tool. Come on down there. And again, I called it 98. It says 97, 97 right here. If you want to get really precise, that's probably what we're going to hit, and then bounce off there if I'm correct. Otherwise, you have resistance not too far overhead that could still cap it. Anything more than that, anything's possible. Do not get married to any trade, and especially do not get married to a trade on crude oil or natural gas or some of these commodities that can and often do go up or down 10% a day. And just when you think it can't go up anymore or down anymore, it does it again for another day, and then it does it again. So I'm telling you this, if you've been trading for a while and you trade natural gas and crude oil when it's volatile, you know what I'm talking about. If you don't, stay away or you're going to get burned if you don't know what you're doing. These are very volatile, fast-moving things, and sometimes the charts look perfect, the setup, but it just doesn't pan out, or at least I miss something in the charts. So that's it. So you've got now you have this little nice divergence here on the 5-minute, and you can see I also drew there was an uptrend line in these indicators down here. It's been cracked. There's the PPO. It's taken out. It was bouncing along this uptrend line right here. So that's what I think happens tonight. Anything much above that, then I'm wrong, and just look for the next setup. All right, let's wrap it up here. Yeah, I think that's all I wanted to cover today. All right, this has been Randy Finney with the Right Side of the Chart. Have a great day.